Quick tip to help you lower your student loan payments. But first, a question. How many of your kids are your dependents? If you're thinking of your taxes, you're on the wrong track, because when you're paying your federal student loans under one of the legacy IDR plans, that's pay as you earn, IBR, or ICR, your monthly payment is based on your taxable income and your family size. The bigger your family size, the lower your payment. But who counts as part of your family size? Well, you, the borrower, you count. So does your spouse, unless you're separated or divorcing, and so do your children, but only if they're dependents. Now, most people hear dependents and they think of their tax returns, but that's not how dependent is defined for student loan purposes. For a child to be counted as a dependent, they need to rely on you for more than half of their overall needs directly or indirectly. They don't need to be a dependent on your tax return. They don't need to be under the age of 18. They don't need to live with you. And you don't even have to be giving them money because it's directly or indirectly. For example, let's say that you have an adult child living across the country, but you're supporting them for one reason or another. Even if it's temporary, they count. Well, what if they're an adult living under your roof and not contributing their fair share to things like food, mortgage, rent, utilities? They count, because they're relying on you indirectly. How about if they're away at college? They still count unless they're supporting themselves. And finally, what if you share custody of them? If you're footing the bill for more than half of their needs directly or indirectly, they count. So the next question that my clients typically ask is, what proof of all of this do you provide? And the answer is pretty simple: none at all. It's an honor system. So if you think that you provide for more than half of their overall needs directly or indirectly, your child is your dependent, and therefore you can count them as part of your family size. End of story. Remember, the larger your family size, the lower your federal student loan payments under any of the legacy IDR plans. In fact, your student loan payments will go down by $106.50 per month if your family size increases by one person. That's nearly $1,300 a year. Questions about your federal student loans, your private student loans, or any other type of debt? Get in touch. You know where to find me.